Okay, now we're going to have a closer look at actual commodities and the commodity markets and have a discussion on what is a commodity, what is a futures contract, who trades the futures markets and why, your trading office, what is a futures broker, and we're going to have a little closer look at the software that we use to access the markets and actually place trades. And we're also going to discuss how to set up a futures trading account. Okay, so what is a commodity? A commodity is basically anything that can be grown or mined or taken out of the ground. And some of the most commonly traded markets in the world are the gold market, crude oil market. We have the grains, which we have corn, we have wheat, soybeans, and then we have natural gas as just some of the examples of the markets that can be traded. There are two major participants in the for those who wish to access the futures markets, and they are the hedgers and the speculators. And the hedgers are the ones who actually produce the commodity, and the others are the business owners who use that commodity as part of their business. And if we take an example of a tomato grower and a tomato processor, both these businesses have specific goals, and that is to make profit. The tomato grower has an idea of what his costs are to produce, say, 100 boxes of tomatoes. And his aim, let's say, is to produce, or he knows his cost to produce one box of tomatoes is, let's say, $5. If the grower knows that in 1 month's time he will have 100 boxes of tomatoes to sell to the market, he has two choices. One, he can wait until the tomatoes are grown and physically take those tomatoes to a marketplace and sell to a buyer. Or two, he has an option of perhaps selling or guaranteeing a futures price for his 100 boxes of tomatoes, let's say in 30 days' time. If he knows that his box of tomatoes is going to cost him $5 to produce, and somebody is willing to buy that 100 boxes of tomatoes from him in 1 month's time at $7, then he has a known price that he can sell his tomatoes at. And he may enter into what we would classify as a futures contract and lock in a fixed sale price of $7 for his box of tomatoes in 30 days. So having that as a known fact, he can go about his daily business of growing his tomatoes, knowing that in 30 days' time, he can turn up to a marketplace and have a fixed sale price already guaranteed of $7. What he must produce is his 100 boxes of tomatoes, and generally they will have a specific quality and grade. Knowing that his cost is $5 per box, and knowing also that he has sold his 100 boxes of tomatoes at $7 a box, what he is guaranteeing is he locks in $2 profit. All he has to do now is turn up to the market with his 100 boxes of a specific grade and quantity and find the buyer who is willing to pay $7 per box for his tomatoes. On the other side of this transaction, we have in this case, a tomato processor or cannery. They know what it costs to keep their business in operation, and they also need a guaranteed supply of tomatoes to keep their business operating. If they know that they can make a profit from buying a box of tomatoes at $7, processing those tomatoes and selling an end product at a profit of, say, $10 a box, they would be a happy buyer from the tomato grower at $7. Therefore, we have two participants who have separate goals and separate ideals. They know their costs of production, and they know what price they need to sell at to make a profit. Therefore, we have two parties or enterprises who are entering into an agreement at a future date to buy a specified quantity and quality of a product, in this case tomatoes, at a guaranteed price. The tomato grower turns up at the marketplace with his tomatoes. The tomato processor, the buyer, turns up at the marketplace, and they fulfill the contract at $7 per box. What this does for both a buyer and a seller is it guarantees a fixed price. This fixed price enables them to structure their cash flow and know what their profit will be. The futures markets are a global marketplace where buyers and sellers of a commodity agree on a price and of a specific grade and quantity of a product. What these end users and producers are looking to do is to eliminate their risk by guaranteeing a fixed price for a specific grade of product. We're going to have a discussion on crude oil. Now, crude oil is one of the most traded or the most liquid commodity futures markets in the world. And the reason for this is it is a global commodity. The derivative products from crude oil are numerous and include daily products. They include the asphalt for roads, the lubricating oil for trucks, the gas oil to run ships, the aviation gasoline to run jet fuel for aeroplanes, petrol and gasoline for our motor vehicles, petrochemical products for plastics, liquid petroleum gas for heating. So we can see that the derivative products from crude oil are vast and used by all of us in our daily lives, both for our personal use and for business use. We can see from this chart in front of us the refining process of crude oil. Crude oil is taken from a storage tank. It is simply put into a boiler. And from this boiler, at different temperatures, we get the derivative products all up this chain here. So we can see the uses of crude oil are extensive. And there are many buyers and sellers of crude oil for the reason simply of being able to, one, not only use the derivative product, but also produce other things like our plastics that we see in plastic bags, all the vinyl products. So there's many different participants of those who need crude oil as part of their production or in their business process. The producers and the end users of commodity products have a choice when they deal in a contract to buy and sell. One of the original ways of international business was an agreement or a forward transaction. A forward transaction enabled the supplier, let's say the oil driller, to go about his business of producing oil. He would have a known quantity or an estimated known quantity of the amount of oil that he could produce. What he needed to guarantee a sale and a sale price was a forward contract. These forward contracts were usually done with governments and large business users of the product, like a refining company. Forward contracts were useful in the fact that they were customized and they were usually transacted between two parties. The two parties would know the known grade of, in this case, oil. They would know the amount of oil that they would be transacting, and they would agree on a price at a forward date. The forward date contracts were used to be transacted, and they still are, in 3, 6-month and 12-monthly contracts, and are renegotiated at the end of these periods. If we have a look at like a 12-month contract, that's a pretty fixed, it's a fixed rate for 12-month supply of a commodity. Now, throughout that 12-month period, the price of that commodity can vary greatly. And that will depend on, one, economic performance of a country. Perhaps wars would come about. With crude oil, it can be a very, very volatile contract based on a range of different economic and global factors. If you were a supplier of crude oil, it is a nice situation to know that you do have a guaranteed buyer and at a fixed price, and you can supply your product for 12 months. However, the forward contracts become quite restrictive as the price of the commodity can rise and fall sharply. So this may be a detriment to one, the supplier, and two, the end user. Also with a forward contract, what you have is a somewhat high counterparty risk. And that risk is associated with one, the supplier perhaps not being able to provide the guaranteed or the specific amount of the commodity as per the contract, or you may have the buyer who may not be able to fulfill their agreement on the payment. So this becomes an unregulated market situation where there has to be a lot of trust in both the buyer and the seller to fulfill the transaction. One of the benefits of a forward contract was there was no initial payment required. Once the supply of the commodity was delivered, then a payment would be transacted. The other options that buyers and sellers have, or the driller and the refiner in this case, are the futures markets. What the futures markets provide is a standardized quantity, quality of product. There's a low counterparty risk with trading futures because the markets are traded on a global exchange where the buyer does not know who the seller is, and transactions are transacted through what we call a clearinghouse. That clearinghouse matches off a buyer and a seller. So this eliminates or basically reduces the counterparty risk associated with dealing in a fixed price commodity, or those looking to hedge up a price from the buy or the sell side. Now, to be able to trade a futures contract, there has to be an initial margin payment required. That is a small deposit that is placed with the clearinghouse by the buyer and the seller to guarantee against price movements in the commodity. The biggest factor about the futures markets are that they are regulated. They are regulated by government agencies. So the rules that apply to trading futures markets are known by everybody. It's very transparent. This transparency allows for liquidity and confidence for those who are willing to trade or willing to look to hedge up their risk in the market. So just quickly, producers and end users, they are the hedgers. And they use the futures markets as a risk management strategy, which is used in limiting or offsetting the probability of loss from fluctuations in the price of commodities. So in effect, a hedging is a transfer of risk without buying an insurance policy. So let's just say an oil driller, its production cost is $30 per barrel. He can sell into a futures market at $50 per barrel and lock in $20 profit. An oil refiner knows that they will need 100,000 barrels of oil in 3 months. They know that if they can lock in a price in 3 months' time at $50 per barrel, they will profit from their refinery production. So they buy into the futures market at $50 a barrel to lock in a guaranteed price. So this is about locking in fixed prices for both the producer and the end user. Now, if the producer and the end user are looking to lock in prices, then there has to be another party to a transaction who is willing to take that risk on that the producer and the hedgers are looking to fix. So they're looking to fix prices from a floating price to a fixed price. The speculators are the ones in the market who are taking the risk off the hedgers. As traders or speculators, that can be day traders, medium-term traders, long-term traders, The speculators are the ones who are taking the risk. We are looking for or trying to predict upward and downward movement in prices to make profits. So let's look at a futures contract in its specifics. A futures contract is a contractual agreement, and it's generally made on the trading floor of a futures exchange, or more commonly now electronically, to buy or sell a particular commodity or financial instrument at a predetermined price in the future. Futures contracts detail the quality and quantity of the underlying asset. They are standardized to facilitate trading on a futures exchange. Some futures contracts may call for a physical delivery of the asset, whereas others are settled in cash. I'd just like to point out that most of the futures contracts traded are closed out before the futures expiry date, which means only 1 to 2% of futures contracts actually go to delivery, or where somebody who is looking to supply and somebody who's looking to buy actually make the physical transaction to complete their business. So how do we access the futures markets? Well, we're going to need a futures broker. A futures or commodity broker is a firm who executes orders to buy or sell futures contracts on behalf of clients and charges them a commission. And we can just see through this little flow chart here, an investor or a speculator in our case. We confirm our order with the broker, who then places that order on an exchange or a marketplace. Once that order is transacted, the order is held by the clearinghouse. The clearinghouse will hold that position until closed by the investor. If the positions are held overnight, then a daily margin is required. But as day traders, this is not a situation that we have to go through. We have to place an initial margin while our position is open. But once we close our futures trading position, our margin is automatically placed back into our trading account. So when we close a position, we go back through our broker, we close the position through the exchange, the clearinghouse offsets our buy with our sell. The difference between the buying and the selling price, whether it be a profit or loss, is then placed into our trading account as a credit or a debit. So the clients of the futures broker or the commodity those who trade the commodity contracts are either the hedgers using the futures markets to manage their risk, or they're the speculators. We're the ones who are willing to take on that risk. We are the speculators, and how we get access to the markets is we need to open a futures broker's account. I've just got some links down here of some futures brokers. We have AMP Futures, we have RJO O'Brien, and we have Ninja Trader. So there's some links that you're more than willing to go and have a look at, and the process of opening a trading account is within those links. In our next video, we're going to have a look at actually how do we start trading. Thank you for listening to that, and back soon.